Today we start talking about some practical concepts. We are going to discuss what is a share, what is the stock market, all the basic pieces that we need to build our strategy. And so let's get started. Let's start first to understand exactly what is a stock. A stock represents an ownership in a company. When you own a stock, you're technically an owner of a company, which is a business that is listed in a stock exchange. And in a simplified word, if Apple only had 10 shares in the market and you would buy one, you are in fact the owner of 10% of that company. In reality, Apple, yes, has billions of shares in circulation, but technically, when you buy a share, you are becoming a business owner. Even if of a very tiny piece of the company, you still are an owner. And so you want to understand these concepts to start thinking about investing as actually buying businesses. And you want to buy good businesses. And why do we buy a share, therefore a business? Because people want the price of this share to increase. And this can happen for two reasons. Either if the business grows, or if we expect that the business will grow in the future. So if we have a share that we buy at 100 pound, and then they tell us that in the past 12 months they made 50% more revenues, everybody will think, oh wow, that share, that stock, that business is great, I want to buy it too. And so this will create more people buying the stock and therefore the price going higher. The second reason is if we expect some future growth. For example, if we have this business that because of some new trend, like could be AI, we expect that this business will benefit from it a lot, then we buy it today because we expect the growth to happen in the future. These are the only two reasons for which a stock increase in price. And you may hear me saying stock, share a couple of times. I use these two terms a bit more in an interchangeable way, but there are a bit of differences. A stock represents an ownership interest in a company, typically referring to a collective group of shares, while a share is the single unit of ownership in a company, representing a portion of the stock. It's like saying money and 1 pound. Okay, one is the unit, the other is the collective average of that of those units. And so I'll use mostly stock, but technically, to be very precise, when we talk about buying 10 shares, we shouldn't say we buy 10 stocks, because buying 10 stocks means that you buy Amazon, Apple, Meta, and so forth, different companies, while the shares refer to the units, and you can buy multiple of them. All right, so having made this clear, let's keep going. The stock market is not a place, but it's just a term to refer to the aggregate investors. So when we say we are going to invest in the stock market, it's not that we are going to a place and we buy something like the supermarket, but we are referring to the collective investments and investors that happen regarding these businesses that are traded as shares. And so this is why we don't say I am going to buy at the stock market, but we say I'm going to buy at the stock exchange of New York Stock Exchange, for example. And this is a very important concept because otherwise, if we have a lot of confusion about what is the stock market, it's very difficult to go more in depth. So the stock exchange is where things happen, right? And this is where buyers and sellers meet online to trade shares. So there are a total of 60 stock exchanges in the world. Most of the developed countries have one or multiple stock exchanges. And of these, 16 exchanges account for 87% of the global market capitalization. So it's really difficult that you're going to use the Israeli stock exchange, like it's very tiny, it exists, but usually you'll never use any other stock exchange rather than the London Stock Exchange, the Frankfurt Stock Exchange, the New York one. Those are the main three that we consider. And why would an investor need to use multiple exchanges, given that we have multiple ones? Number one is that the companies need to actually agree to trade their stock in each of these stock exchanges. And so medium-sized companies may not be available everywhere. If you look for Amazon, you're likely going to find this stock in all the 60 stock exchanges in the world. But if maybe you're interested in a local company, maybe you're looking at a company that is based in Frankfurt in Germany and does things only in the German market, yeah, you probably find that in the Xetra stock exchange, which is the Frankfurt one, but it's unlikely that you'll find it anywhere else. And so this is why it's very important to know about a couple of stock exchanges to use them when it's needed. One more thing, your broker may not give you access to certain stock exchanges. And so it could also limit you to be able to invest in a certain stock exchange, and so you need to find another one as a turnaround. Okay, so now we are clear also on what is a stock exchange. The thing that we want to understand is that per each stock, there is a number of buyers and sellers which place their offers. There are people that say, I want £100 for this one share that I'm going to sell. And there are people that say, I want a share of Apple and I'm going to offer £120. The place in which these transactions happen is the stock exchange. And we have multiple stock exchanges, as we said. One of them is the New York Stock Exchange, which is based in New York. And just here, this stock exchange hosts 2,800 different stocks, different companies. And for each one of these, there are buyers from one end and sellers from the other that try to do these transactions. And the volume of transactions is called trading volume. And here is the key part. The fact that each transaction causes the price to change. Because we see, oh, Apple share went up 2% or down 1%, or they went down £10 or whatever. But how does that happen? Well, the truth is that anytime a transaction takes place, that is the new price of the stock. And this news is given to all the other investors as reference point. And so if investor A and B now trades Apple for £105, all the other investors say, okay, two people traded the share for that price. Now that's the reference point from which we will go up or down. All these tiny transactions make the chart of the stock. And so that's how it happens. And so let's go a bit more in details to understand how does this happen in place. Because here we have an example of let's say again, Apple share, to keep things simple, in which we need to understand that the price of a stock is determined by the orders of buyers and sellers. Not the order in the sense of priority, but orders as I'm ordering one share of Apple for £90, or I'm selling one share of Apple for 105. That's an order, as if going to the supermarket and say, I want an order of bananas, okay? That's the same exact thing. And the fact is that not everybody will get their share at the price they want. Because let's imagine that these are the orders. This is the book of orders in which we have three people, Anna, Franco, and Mario, that are willing to sell one share of Apple each for these respective prices. So Anna, Franco, and Mario are this guy here, and Luigi, Fabio, Giacomo are this guy here, and they are trading the same share, okay? So Anna says, I want a share of Apple for 110. And Franco says, well, I'm going to offer 105 for the same thing. I want to sell one share for 105. And Mario says, well, I'm willing to give a share of Apple for just £100. So this is the situation. Now, Giacomo comes here and says, hey, here is £90, give me one share of Apple. Nothing happens because no one here is willing to make that trade. They're saying, dude, look at our numbers, they are higher. Fabio comes and says, no, I'm going to offer 95, but it's still too little. Then Luigi comes across and says, hey Mario, I'm okay to give you £100, but I want your share back. The moment in which two people are in the same speculative transaction, they are fine with this. Luigi wants one share of Apple and he's going to give £100. Mario wants £100 and he's going to give one share. Then the transaction takes place. And that's the new price of the stock. Anytime that you put in a price for a stock that someone else on the opposite side of the trade is willing to do, it will happen instantaneously. That's how the stock market works. That's what the stock market facilitates. Now, let's quickly summarize the concepts. Stock is the ownership of a piece of a business. Share, single unit of ownership in a company representing a portion of the stock. Stock market is the aggregation of buyers and sellers of stocks, not the place, but the general accumulation of all the investors. The stock exchange is the place where buyers and sellers meet electronically, and it's also where these transactions are facilitated instantaneously. And the stock price is the price at which buyers and sellers of a certain stock agree to trade. And when that trade happens, it becomes a reference point for all the future transactions. And all these tiny transactions then make the graph of a stock that you see. Because it says, okay, at 9 a.m., someone exchanged the stock for £100. At 9 and 5, now two people agreed on 101. Then there was a bad news about Apple, and so everybody went to trade at 95. All the tiny pieces of the transactions, it's what makes the stock graph and chart. Hope this is interesting. See you next time.